and welcome to Money Matters TV. I'm your host, Mike Dever. I'm founder and chief innovation officer of Brandywine Asset Management. And my two co-hosts today are Jeff Watkinson of Watkinson Capital Advisors, their muni bond market specialist, and Eric Parnell of Great Valley Advisors. Hello, Jeff and Eric.
Hello, Mike.
Mike, how are you?
Hey, doing great, thank you. So we've got the last time we got together, we started touching a little bit on investor behavior and how that might affect their positions they take in stocks and bonds and whether they're making money doing that. And I thought it would be a great topic to continue today in maybe a little more depth, a little more discussion. And I thought I'd start with a graphic. And this shows, and this is published by Dalbar. Morningstar publishes similar type studies, but they publish this every year, and they show the performance of investors in the various funds that they essentially underperform the various funds in which they invest by as much as 3 to 5% per year. This came out of my book 14 years ago. I had it published in there. It looks identical today. Year after year, the rolling window of underperformance is sustained. So the question I have is why? Why are investors so poor at timing the market or investing that they actually underperform by a significant amount the very funds into which they invest? What's your views?
Yeah, so I'll jump in there, Mike. And it's a tale as old as investing time itself. I think back to when I first came into the industry over 30 years ago, and it was one of the first narratives is that you have a manager or an investment solution that's doing well for a certain period of time. And the natural investor instinct is to think, oh, well, there's got to be something special here. There's got to be some special knowledge that the fund manager must have in order for them to outperform. And really, more often than not, it's something, a certain aspect of what they're doing happens to be in favor at any given point in time in the market. And one of the things that we see time and time again is that market leadership is always changing and it's always rotating. And right about the time that everybody figures out that something is working really well and they start rushing to one side of the boat, well, the investment opportunity has moved on to the next great thing. And, we see it time and time again. It can be within a 1 year period or a 2 year period or even like a 3 month period. And it just happens time and time again.
Yeah, you're exactly right there. I mean, I like to say that it gets down to a fortuitous combination of the advisor bias and the market conditions. And there are periods where those match up exactly well and the advisor is just tearing it up, and then periods where it doesn't. What's interesting is the studies that S&P publishes, I think it's annual, might be twice a year, but their persistence report where they show how active managers have performed recently and versus past. And what you see in those reports is that seldom do the same managers over a 5-year window that are in the top quintile continue even in the top half over the ensuing 5-year period. They fall out of favor. That whatever their style was in sync with the market. It did great, and then falls out of favor. The other thing that's really telling about those reports is that the longer that the track record for an advisor, the lower their probability of outperforming their benchmark. Which, if you think about it, that's a gambling profile. That the longer you sit at the table, the more you're going to lose. And that's the performance we see across those persistence reports published by Standard & Poor's. Jeff, you have thoughts on this?
Yeah, I've read those reports as well. And you guys gentlemen are talking about the equity markets. And, obviously we're focused on fixed income, which is more loss averse. And what I found in my research is people investing in equity stocks, a lot of it can be fear of missing out, aka chasing the dragon, chasing last year's winners. But going right back to municipal bonds, we've had a lack of persistence at times. We started our firm in 2009 when interest rates were at a generational low, and one of the objections we consistently got was, I'm going to wait until rates go up so people keep their capital in cash. Remember, money markets were earning 1/100th of 1%, and they were not getting that daily accrual. Again, time in the market, with bonds just the same as stocks. It's all about time in the market. And that conversation we had with prospective investors in 2010, next thing you know, it's 2013, 2016, and rates didn't come up until 2022. And they kept saying, I'm going to wait until rates come up. Lack of persistence, that really helped hurt their entry point on the municipal side.
What do you see now? Is there, with rates up, are you getting more demand from investors?
Yes, there is. I mean, we're seeing generationally attractive entry points in the municipal market now, with nominal yields above 4%. And if you're in a high tax bracket, you're a high earner, we're looking at tax equivalent yields over 7.5%.
I was going to say 7 or 8%
in high tax states. And demand last year, we measured demand by mutual fund, municipal bond mutual fund flows.
Mm-hmm.
Are they net positive? That means strong demand. And how much? And or is it net negative? And that's really an indicator that shows us what is demand on the street. Real quick, the story I always like to tell was 2021, when interest rates were still extremely low. The 10-year Treasury was at 1%. Right now it's at around a 4.30 10-year Treasury, 4.3% yield. And there was $2 billion a week of net positive flows in the municipal bond mutual funds. I mean, it sky high prices, low yields, and even the last couple of years we've seen yields above 4%, even 5%.
Sure.
Investment grade paper, and the demand has been nowhere near what we saw when prices were sky high back in 2021.
Could that be, and Eric, I want to get what are you seeing on the equity front? I mean, could that be because bonds are only yielding, even if it's tax equivalent 7.5%, stocks are doing 20% a year?
Yeah.
Is that the competition, Eric? Or what do you think? I mean, are you seeing flows into stocks, or are people getting cautious?
Well, it's one of the things that was interesting in the years after the financial crisis. One of the contradictions that we would see is that we would see massive money flows into the bond market, which helps support those low yields that Jeff was talking about. But we were seeing net outflows out of mutual funds and ETFs from retail and institutional investors for nearly a decade after the financial crisis. And the reason it was a contradiction is because the S&P 500, the U.S. stock market, did fantastically well.
Absolutely.
In that post-financial crisis period. And a lot of that can really be attributable to the support that markets were getting from a monetary policy perspective. One of the things that I think, we had the inflation outbreak in 2022, but one of the best outcomes associated with that is that it normalized interest rates. It caused interest rates to come off that 1% to 2% floor on the 10-year Treasury yield up to a more historically normal 4 or 4.5% range. Now, with higher yields, that should presumably imply lower stock valuations. But one of the things we've seen is that stock valuations have actually become even more expensive in the last few years, despite the rise in bond yields. And we attribute that to a lot of it's been concentrated in the technology sector, and earnings growth has been strong. So as long as earnings growth remains strong, I think we'll continue to see net inflows into stocks. But if we hit any type of stall speed, or if the economy starts to slow into recession, there could be an unpleasant valuation adjustment that takes place given these higher bond yields we see today.
Okay, and another thing, I mean, you're seeing obviously people are willing to pay more and more for these stocks, and PEs are going up, and the CAPE, is cyclically adjusted price earnings is going up, and essentially the second highest it's been in history. But at the same time, I'm looking at some of these studies, and Gallup had a study that showed there's this split between political parties where the Republicans were 25%, had 25% more of them were bullish than Democrats. Do you see that as a reflection on economic policy, or the fact that Trump's leading the charge and the Republicans believe everything he says, where the Democrats fight everything he says? What would describe that political party differential?
Yeah, it's interesting. And it really has been a phenomenon that has picked up speed in the last 20 years, I think, in particular. And, I think about the end of the Bush presidency, the Obama presidency, the first Trump administration, the Biden administration, now the second Trump administration. There's a perception among investors, and that bias has been repeatedly true. If a investor that has more of a Democratic leaning feels better about stock market prospects when the Democrats in power. A Republican investor feels better about their prospects when the Republicans in power. But the reality of it is that markets don't care whether a Republican or Democrat is in the White House, whether they control the Senate or the House. I mean, you can move the needle a little bit if one party has power across all three branches, or the executive branch, the House, and the Senate. But even then, the economy is going to do what the economy is going to do. Corporations are going to generate the earnings they're going to do or not. Can it make a difference on the margin? Sure. But not in any material or sustained way, at least we've seen over the course of history.
Yeah, that is interesting. That's just another form of bias. You've got these political biases that do it. In my book, one of the studies I did, which was really interesting, because we had a company we're running called Fan Channels that had a bunch of professional athletes posting almost like a Facebook for them, and we polled the viewers of that, and we had just thousands of them that reported in which team at the next weekend they favored. And it was essentially 9 to 1, maybe, that the same game, but if it was a Philadelphia fan against Giants, Philadelphia was going to win. If it was a Giants fan, Giants are going to win. Same game, but it was just skewed so dramatically because of these biases. So now you see the same thing politically. I do have a question here, a viewer question, Eric, that you can answer. It's from Rob Walker in Philadelphia. It's relevant to what we're saying here. What political issue in the future will affect the stock market the most?
It's a great question, Robert. And, we got a partial answer to that question recently. And it has really revolves around the Federal Reserve. One of the key tenets of market confidence, going back to the financial crisis and really going all the way back to the 1987 stock market crash, was this notion that the Fed would be there to save the day, and they'd be able to carry out monetary policy with independence. And that's something that's really come into question here in the last couple of years, is that will the U.S. Federal Reserve, the holders of U.S. monetary policy, as well as the people who oversee the global reserve currency, will they be able to maintain their independence in carrying out monetary policy? And that's going to be a key question to watch as we go through the remainder of 2026 and over the next few years, is that, does the Federal Reserve continue to be able to operate independently to lower interest rates when the economic conditions warrant, and also to raise interest rates, arguably more importantly, if we start to see inflationary pressures take hold? And that's going to be a real key to watch here in the next few years.
I'd like to, Mike.
I was going to ask you, Jeff, what do you think there? Yeah, go ahead.
From my experience in the business, the market, the stock market, they love gridlock. They love divided government. And it proved, things aren't going to happen. There's not going to be a major legislation, and they can cook. And the markets know what the rules are going to be. Companies know what the rules are going to be, and they're not expecting any political risk. And obviously, the odds of, in a midterm election, the party not in power regaining one or two chambers of Congress, I think those odds historically are very high. And that's
So that's favorable.
That's
your view is
favorable.
favorable. Mm-hmm.
But that's not until October, November, first Tuesday in November. But
Yeah, so it's sort of the do no harm philosophy, I guess, right? If they're divided, they can't pass anything that's going to screw something up. Markets will take care of themselves. The world will be in a shiny spot. Now, of course, last year was a great counterexample in a way, because I mean we definitely had the tariff tantrum where things just crapped out overnight practically, but pretty
is that a
quickly,
technical term?
Yeah, they absolutely, yeah, highly technical, but it totally rebounded from there to where you had 40-50% gains off those lows in the equity markets. I mean, that's with a single party in control and really shaking things up too. It wasn't like they were nothing going on. There was stuff going on all the way, and you still had that rally out of those lows that was fairly historic actually. How would you explain that?
Mike, I use this tool online, which someone in the business referred to me a couple of years ago. It's the AAIII sentiment. It's a poll, and if you're bullish, neutral, or bearish.
Yeah, so the American Association Individual Investors.
Yes, sir.
And their weekly poll they do. Correct. Mm-hmm.
So historical average, 37.5% bullish, 31% neutral, 31% bearish. The 1 year bearish high, which you just mentioned, that's why I raised my hand and jumped in, was 62% bearish, April 2nd, 2025.
Mm-hmm.
And that was if you think contrarian, when everyone's bearish, that was an excellent entry point. Looking at the VIX, the fear index, that's also another terrific indicator of bearish sentiment and elevated VIX. Currently, we're at 44% bullish, 31% bearish, which it's a little high on the bullish side. This is the end of last week.
Okay.
We'll see what it is at the end of this week.
Well, yeah, no, I know. Yeah, but that's interesting what you say, because I have another graphic I want to show. This is just a study called a trading strategy that shows how you could make money fading the crowd, and it takes advantage of what we saw in the Dalbar study, was that people underperform the very markets, funds into which they invest, meaning they're buying when they should be selling when they should be buying. What you just pointed out with the AAII study, that bullishness peaks probably near a top, and bearishness is going to peak at the bottom. And so you want to fade that behavior. All this is doing is saying, hey, when these aggressive ETFs, and I published this in my book 14 years ago, and at that time, there was just that first part of the graph in place, and it showed that the market, you could have made some money. This is how much profit you'd make by doing the opposite of what these indicators are saying, what people say. If they're super bullish, you want to sell. If they're super bearish, you want to buy. And through the teens, there wasn't a whole lot of emotion to take advantage of, but you see that big spike at the end, and I ended this right there when we published this 4 or 5 years ago. That was the COVID crash. So in COVID, you had everybody doing exactly the opposite of what they should be doing. When that crash started to happen in March of 2020, people started selling. But very quickly, they said, I'm buying the dip, I'm buying the dip. And they bought the dip just in time for the real COVID crash to hit. Market go down 33%, and they all bailed. And if you faded that behavior and bought when they were bailing, you caught the rest of that year with another, 50% gain off the lows type of recovery, like we had out of the tariff tantrum. So it's almost astounding how predictable it is if you can keep your head on straight. And when others are panicking, you can make a lot of money with a systematic, structured behavior. Even if you don't do that, the point is, when you feel like you need to do something dramatically, you have to do it. Don't. Go on vacation, step away, because it's probably the wrong thing if you're that confident about it. Eric, you have any thoughts on those?
No, it's extraordinary, because investing is probably the only marketplace that I can think of where, unlike most people who, it's Black Friday and they want to go out to the stores because they like to buy things on sale, and people like to sell things when they can sell it for a high price. Investing is probably the only marketplace that I can think of where investors or people are upside down in their psychology, where, when prices are rising, they want to go out and buy more of it. They want to chase it because the price is high, and they'll go and buy when things are expensive. And then when things go on sale, they want to get rid of it. It's
Absolutely.
I understand that when you're seeing prices move violently in one direction or another at any given point in time. But if you as an investor can maintain the discipline when you're seeing people all rush to one side of the boat, or one, chasing after a certain theme, we've seen it recently in precious metals. You had the price of silver that spent 45 years trying to get over $50 an ounce. And then in 3 months after it finally broke up above $50 an ounce, it rose to $124 an ounce. Well, there's a little too much bullishness going on at that point. So if you were somebody that was silver curious, you probably want to wait because things have gotten a little bit too exuberant.
Well,
and one of the questions that an investor should always ask is that if so many people are so bullish, is there anybody else that's going to be even more bullish that's going to want to buy at a higher price? And that hurdle gets higher and higher. Harder.
And the silver is a great example. I saw somebody over the weekend talking about the flows that were going into the silver market, and the fact that those flows essentially had to quadruple in size just to sustain the price that it currently had risen to. Saturday night this past week, so silver was peaking in the 120s on end of last week. I was talking with an advisor, and he said, yeah, it could go to $300. And I showed him the chart. It's not even a parabolic chart of silver. It was just a straight line up. And he just stood by that. Monday, boom, it's peaked to trough. It had a $50 move. It was the biggest move ever in the entire history of the silver market, on the lows there. And you could almost see that it had to happen, just because of the enthusiasm that was in the market and people buying it. It was making one-day moves that were bigger than the price of silver 2 years prior, in total. So, yeah, when you start seeing extremes like that, you pretty much know you're probably near a peak. Another example I have is 1979. I had an investor who called me and said they were retiring. They wanted to.
What year was that, Mike?
I'm sorry, 1999. Thank you for correcting that.
I was born in 1979. Okay.
There you go. I actually started trading in 79, Jeff, but wow. Don't tell anybody that. But in 1999, this investor called and said he was taking money out of the hedge fund I had, and he wanted to put it in something since he was retiring. And I asked where, and he said, "Well, I just want to put it somewhere where I can get a safe 20% return." Exactly. I laughed just like that. And the point was, he had been seeing year after year 20% returns. And at the end of 99, we had stocks like Cisco go up 1,000%. And so people just thought that was something they could do and they could get. Unfortunately for him, 2 years later, he called with about 40% of the money left to reinvest. I had something similar just this past year. An investor called. She didn't say safe for 20% return, but she said she just wanted to put her money somewhere where she could get a 20% return. And people just accept these days that that's something that's normal and natural. So we're kind of in that frothy phase, whether that's the actual top or not, who knows? But, we're definitely not like we were last April 2nd with the tariff tantrum and 60% bearish.
Yeah, I'll flip it to you. Thinking about it from the other perspective, a topic that's really hit the headlines here the last few days is the impact of artificial intelligence on computer software companies and technology software companies. And, the notion being that AI could render a lot of these software companies obsolete. Well, the first thing, it's not like AI just suddenly came along. This has been out there for a while. AI has been rolling along and kind of changing different industries. But it's been phenomenal to watch over the past week or so to see the dramatic plunge in software stocks there's no differentiation in terms of who's being sold. They're just, these software stocks are just being, thrown overboard over this concern. And that's another way that investors can really benefit if they can maintain their discipline. And if they're also willing to do the homework and go into the marketplace and say, hey, what stocks are really going to be under threat because of the advent of artificial intelligence and the proliferation of artificial intelligence, and what companies are being unfairly sold off here. So, this whole sentiment and this notion just comes across, software is, AI is bad for software, so just sell them all, that behavioral response.
Mm-hmm.
That's what brings opportunity for those that have the discipline to keep a cool head about themselves.
Yeah, absolutely. I had another kind of quote. It was a TV interview number of years back that Peter Lynch said that. Now, Magellan Fund at Fidelity, which Peter Lynch ran for a number of years, that was clearly one of the top performing funds for decade and a half, over 20% annualized returns. And in the interview, he said that he had investors who actually lost money investing with him during that term. And I saw the same thing. I set up a fund in the early 1980s with, at that time, brand new manager called Paul Tudor Jones. Paul went on to a lot of great fame over the years and did phenomenally well. And with our fund, we went 6 years where he was super double-digit returns, a couple years triple-digit returns. I had one investor who lost on the investment with Paul over 30%. It's because she came in and he had a 3-month period where he just couldn't do anything right. And she pulled out, and not only pulled out, but mad and yelling at me. And had she just stayed that year, she probably would have doubled her money. But you just can't stop some people from getting emotional over the investing, and as you're pointing out, bailing out of good stocks because they're kind of lumped in with maybe something that is at risk, as a bad stock. And definitely not taking advantage of that when those good stocks are sold off. Yeah, I was going to say, Jeff, do you see any of that kind of same extremes in behavior with your marketplace, with munis?
Absolutely. COVID, there were no bids, and you had the people, if they wanted to sell, they had to cut the prices of their bonds. It was extraordinary. The third week of March 2020.
Right. Yeah. So you want to, if you have the ability, you want to take advantage of it when you see the panic, the blood in the streets. There's definitely opportunities when you see people that are looking for those safe 20% returns, and not just looking for it, but assured they're going to receive those. Maybe you need to be a little more, cautious as well. So I appreciate your time, guys. This is a topic that we can go on forever with. It's so important. I'll just wrap it by saying, I think if people can follow a disciplined approach, if they have a systematic process, so much the better. But absolutely don't sit there day to day reading the paper and watching the news, whatever come across your screen, and try to react to that. You will absolutely end up as one of those doll bar victims that are underperforming the funds into which you invest by multiple percentage points per year. But thanks, Jeff. Thank you, Eric. Our next guest on Money Matters TV is Pedro Aurora, CEO of Vivitech. And until then, thank you for watching Money Matters TV, where your money matters. See you next time.